I'm here to tell you that rate hikes in 2026 are officially back on the table. Now, last Friday, when we got the May payrolls report, the payroll report came in really, really great. However, the S&P 500 turned lower. In this video, we're going to talk about why that is and what they have to do with rate hikes. So if you look here on the table here on the left, I've got some 4 fast facts for the payroll report. Non-farm payrolls were 172,000 versus 80,000 consensus. The payrolls came in almost double the expectations for jobs added. Not only that, but March payrolls were revised up 29,000 and April payrolls were revised up 64,000. That is a lot of added jobs over the last 3 months. And at the same time, the unemployment rate remained unchanged at 4.3%. Now, that all sounds like fantastic news. That is an awesome jobs report. But how come the S&P 500 fell over 200 points once it was released? In fact, President Trump put out a post basically questioning what could have happened to the stock market based on how good the jobs numbers were. And it comes back to the Fed and their dual mandate. But before I get into that, I just want to remind you that on June 30th, so just in a couple weeks, we're hosting a live macro investing workshop ran by Francois Trahan. It is a great half-day event. This is our 3rd year doing it. It gets great reviews every single time. About 90% of the tickets have sold. So by the time you're seeing this, we might be almost sold out. A link is going to be in the description of this video where you can learn more about the event and then reserve your tickets. Again, 90% of the tickets are already gone. So don't get mad at me if it's sold out by the time you're seeing this video. Okay, so as I said, all of this comes back to understanding the Fed's mandate. Now, this is going to be a very simplified version of the Fed's mandate. The goal is here to just provide you with an illustration. Again, I know they factor in much more than what I'm about to say, but basically it's a dual mandate. So they want to keep the economy at full employment and prices stable. So they target 2% inflation and full employment. So there's basically a trade-off or a tug of war, as you can see in this graphic, between inflation and employment markets. A very, very simple way to think about it is when the bigger risk is inflation, the Fed is generally biased towards rate hikes. The trade-off being if interest rates are higher, that can impact employment markets negatively, but it can also limit inflation continuing to accelerate. So when employment markets are strong and the Fed is worried about inflation, the bias is towards rate hikes. That doesn't mean they're going to hike every single meeting, but it just means they're going to be more hawkish than they are dovish. Then on the flip side, when the bigger risk is viewed as employment, the bias turns towards rate cuts. So if the unemployment rate is rising, jobs aren't being added, layoffs are increasing, and inflation is somewhat lower or subdued or controlled, the bias becomes rate cuts to try to stimulate the economy, stimulate investment, stimulate jobs being added. Again, they're not going to cut every single time this is the case, but Fed in general is going to lean more dovish than it does hawkish when the bigger risk is the employment market. So when you think about a really, really strong payroll report, it's a little backwards. It creates this sense that good news is in fact bad news, because what that now tells us is that the Fed is probably going to be more focused on the inflation part of their mandate than they are the employment part of the mandate. And as I said, that biases them towards rate hikes. And that's what we can see when we look at the implied rate changes by the end of 2026. So this is what this chart here measures. The blue area of the chart is the expectation for one or more cuts that is being implied by the market. So at the beginning of the year, you can see it was around 95%. So the market was implying that there was a 95% chance of at least one cut. So again, there was high expectations for 2, 3 cuts, but at least one cut was 95%. You can see how this changed over time. So the red area is no change. So there would be no cuts, no hikes. That reached its peak around March. As you can see, mid-March is where the red area starts to get the biggest, maybe even into early April. But what we've seen over the last month or so is that light blue area, which is one or more hikes, start to become bigger and take up more of this chart. You can see the dark blue more recently, again, over the last few weeks, is effectively at zero. The market is implying a very low chance there is even a single cut by the end of the year. And the one or more hikes is now up to about 60%. I break this down a little bit more granularly by including the 2+ cuts, 2+ hikes. And you can see I just did month end to see how it's changed over time. And you can actually see at the beginning of the year or the end of last year, there was a 75% implied chance that there would be 2 or more cuts. So that big blue, dark blue space at the beginning of the last chart was actually mostly covered by 2 or more cuts. And you can see how that's morphed over time. So if you bring it all the way down to 611, which is the last time I updated this table, you can see no change is now the favorite at 42%. But if you include one hike at 41% and then 2 or more hikes at 16%, you can see that the market now implies that the Fed is going to remain sort of in a hawkish bias state for the rest of 2026. Now, why is that? So we've talked about the employment market, how it's holding up better than anyone has sort of expected to this point. And that's because of inflation. So we have seen back-to-back monthly CPI reports that have shown accelerating inflation. Now, on the headline, this is not that surprising, as that includes food and energy prices. Due to the ongoing war/conflict in Iran, we have seen energy prices soar. So again, the headline inflation number is not super surprising, although in April it did beat a lot of the consensus forecasts. It's the core number that has ticked up. Again, not as dramatically as headline has, obviously, but we are starting to see some flow through to core CPI. And that's what you can see. So from April to May, we saw headline up 0.4%, core up 0.1%, both coming in line with their forecasts, but accelerating nonetheless. So headline inflation is now at its highest since April of 2023, so going back 3 years, and core inflation accelerated to its hottest print since September, so going back about 9 months at this point. So inflation is accelerating. The employment market looks good. If you refer back to the Fed's mandate, they are going to be more hawkish bias, generally speaking, based on their mandate. Now, there's the added question of Fed's new leadership, Kevin Warsh, appointed by President Donald Trump. I have a really great video I'm going to have pop up here covering everything you need to know about him. It's a really great primer. It's a little bit longer than my normal videos, but I do think it's worth watching if you want to get a better sense of who is currently running the Fed. There's been a question if he is going to be somewhat of a Trump patsy. Now, spoiler alert, I cover this in the video. It's going to be hard for him to overcome the general makeup of the Fed and the rules of the Fed to do anything that's outside of what the other governors and other regional Fed presidents think. He is simply one vote. He does have some power to set the agenda, but at the end of the day, he gets one vote just like everyone else. And so what we've seen, if you look at inflation expectations, which is really just a proxy for how much confidence that people have in the Fed to control long-term inflation. So again, these are two different ways to look at long-term inflation. On the left here, we have the 5-year forward break even. So what that basically says is, what is the inflation going to be for 5 years from now? And generally speaking, this number sits around 2% when the market has confidence the Fed will be able to execute their mandate. And as you can see, it's sitting exactly there. It's been slightly elevated above 2% for the last few years This doesn't necessarily have to do with the Fed's ability to control inflation. It could just be we're entering a inflationary part of the cycle, or people think that there are long-term things that could increase inflation over time. But what this chart is telling you is that the market has confidence that the Fed is not going to start abandoning its inflation mandate and start cutting rates unexpectedly. So the market has confidence that they're going to continue with their normal dynamic, which when inflation's a concern, you're not going to get rate cuts. The consumers, on the other side, this is more of a volatile series. It's more based on emotion. It's a survey. People are asked what their inflation expectations are for the next 5 to 10 years. It's generally more elevated than the 5-year forward break even is going to be. And that's because people tend to overreact to more near-term things. So if inflation's higher right now, which it has been over the last few years than it generally was decades prior, people think that inflation is going to be higher in the future. And that's what you see here on the right. So the left is a market-based measure of long-term inflation expectations, and the right is based on consumer feelings in the U-Michigan report. And you can see that has increased a bit. But for now, I would put more stock in the thing on the left when it comes to this topic. I will say inflation expectations, so how consumers are feeling, do flow through to markets, consumer behavior, etc. So if people expect inflation in the future, they start making decisions based on the future inflation. So not to totally discount this chart on the right, but when we talk about if the Fed is going to abandon their mandate or start cutting rates despite inflation risks, it's the market chart on the left that I would pay more attention to. So that's what I'm gonna leave you here today. I hope you enjoyed this video. I hope you learned something new. If you did, it would be great if you could quickly hit the subscribe button. We broke 1,000 subscribers, but that doesn't mean we want to keep pushing higher. So again, thanks for being here, and I will see you next week for another Macro Monday video.